Kohler here, CPA attorney. Let's talk about mortgage interest. This is a big topic, great tax write-off strategy, and I want you to be aware of some of the issues as you go to prepare your tax return. Now let me say this right from the beginning. If you own rental property, investment property, and you have a mortgage involved, that interest is completely tax deductible. There's no limits on that. It's a property for business purposes and the mortgage interest is entirely deductible. But when you go to do your personal return and you're trying to write off the mortgage interest on your personal residence, well, we used to use the itemized deduction strategy for that, right? Well, that's where the changes come into play. So let's go through the 2017 rules and then we can better understand the 2018 rules. It's going to help you make some good decisions on your tax prep for 2017 and money-making decisions in 2018. Now in 2017, we're writing off the mortgage interest on a qualified residence. This is a great thing. We've been doing this for years, and buying a home is a great investment. I want my clients to invest in a home whenever possible. Now I know some of you may live in an urban area where renting is cheaper than buying, and some of you are saving up the money to get in your first home. But the far majority of Americans should be investing in their home, and it's a primary asset of so many of us. Now the interest on this mortgage on the buying a home has always been deductible, and we have loved it. Now there's been some limits. Now here's the rule in 2017. You can deduct all the interest on up to $1 million worth of qualified interest mortgages. Now this is your primary home, qualified residence, sticks and bricks. It could be an RV, it could be a mobile home, a boat. And then you could even deduct the interest on up to $100,000 of refinanced or HELOC or second mortgage interest. So all that was added up and put on an itemized deduction line. And then you again compare it to your standard deduction. And for many years, that was a wonderful way to go. Well, the rules have changed in 2018. Now in 2018, first, bad news. Well, a lot of it's bad news, but the worst news is the HELOC interest, second mortgage interest, is no longer deductible at all. None whatsoever. But for those of you that had a mortgage before on a primary residence acquisition mortgage up to $1 million worth, that interest is still deductible. It's going to get grandfathered in, so that's not going to change. As you buy a new home, any of you out there buy a new home in 2018 until 2023, and then maybe the rule will change again, you can deduct only up to $750,000 of acquisition indebtedness. Not a second mortgage or a refi unless it's on the acquisition indebtedness only. And it's only the interest on up to $750,000 of primary residence acquisition indebtedness. So it really trims back that interest level. Now watch my other video on comparing the itemized deduction to the standard deduction because you're going to add all those up and see where you fall. But this mortgage interest is going to change. Now in summary, get all those mortgage statements, get your records together so you can get the maximum refund and save some taxes. Thanks so much for watching, and if you found that helpful, please look in the description below. I've got links to my tax and legal library, my QuickBooks training videos, how to start a small business, 50, 60, 70 videos, some as long as 30 minutes explaining more information on tax and legal strategies that will change your life. Also, if you'd like to subscribe to my newsletter or check out my social media links, please click here. They're weekly free tips and strategies and articles that you'll find extremely helpful. And I would appreciate it if you'd subscribe to my channel. I've got so many videos here I produce every week on my YouTube channel, and I'd love to give you a ping every time I shoot a new video. Thanks so much, and keep living the American dream.